Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So in this video, I'm going to explain you about journal ledger. In the last three videos, I have explained you about the introduction to the subject financial accounting. So I have explained you in detail regarding financial accounting meaning, its objectives, functions, advantages, limitations, and apart from that, I've explained you about the terms which are used in accounting. I've explained you about accounting cycle, differences between bookkeeping and accounting concepts and accounting conventions, and accounting standards. All these things I have explained you in detail in the last three videos. So if you have watched those videos, definitely you will get the basic foundation. Remember, these videos which I am preparing are very important because these are the basics, foundation of the complete subject financial accounting. If you make a compromise by not understanding this basic theory, then definitely you are at risk. The other chapters you cannot be able to understand. Even in examination, they may ask you the theory question regarding what are accounting concepts, what are accounting conventions, what are accounting standards. So these are the things which every student of accounting must know it. So watch this video till the end to get the complete command on the basics of accounting. This is very important. So I'm beginning with the topic journal. Journal is the first book. Actually, accounting cycle. In the last video, I have explained you accounting cycle. It consists of sequence of activities which are repeated every now and then. In this sequence, the first stage is recording the transactions. Recording the transactions in a book called journal. Later on, the transactions will be posted from journal to ledger. Later on, at the end of the year, all the accounts are balanced and prepare the financial statements, trial balance and financial statements. These are the steps in accounting cycle. First step is recording. Recording the transactions in a book called journal. So journal is a book of original entry. Whenever a transaction takes place in the business, it is first recorded in this book called journal. That's why this book is called book of original entry, because the transactions are first recorded in this journal, right? And apart from that, this journal records the daily book. That's why it is also called a record of daily transactions. Record of daily transactions. It's a book of original entry, right? The process of recording the transactions in the journal is called journalizing. Journalizing is the process of recording the transactions in the journal. Now, what is the format of the journal? I have given you here. The format of the journal will be like this. First column we write the date, next particulars, then LF. LF stands for ledger folio. Ledger folio. Ledger is another book. After completing this ledger, after completing this journal, I'll explain you about ledger. So this transaction is posted to which page number in the ledger? That page number we will write on here, LF. Then DR, debit column, CR, credit column. So this is the format of making the journal. So what I have explained you here, the meaning of the journal. Journal is the book of original entry. Whenever transaction takes place in a business, first the transaction will be recorded in journal. It's a book of original entry because the transactions are first recorded. It is the daily record book, right? The process of recording the transaction is called journalizing. Now I am coming to the accounting rules. Before accounting rules, you must know what do you mean by account. An account is a summary record of all the transactions relating to a person, asset, expense, or gains. So regarding any person, asset, expenses or gains, we record all the transactions, similar transaction at one place. So it's a summary record of all transactions relating to a person, asset, expense or gain. That is called an account. An account will have two sides, left hand side, right hand side. The left hand side is called debit side and the right hand side is called credit side. Now, classification of accounts. The accounts are classified into three categories. So first of all, we divide into two categories, personal and impersonal. Accounts are classified into two, personal and impersonal. Personal accounts are related to persons. The persons may be natural person or artificial person. Example, a business will have dealings with so many persons. That means a business will sell the goods to a person, the business will purchase the goods from a person, the business will take a loan from a person, the business will repay the loan to a person. So the business will have dealing with so many persons. So the business has to open the accounts of those persons. It is called personal account. Now persons are classified into three, that is natural person, artificial person or representative person. Natural person, we are all natural persons, like personal account of Mr. Robert. Robert is a person. Peter is a person. Ram is a person. Rahim is a person. So we will open the account of that person. Is called natural personal account. Artificial person like XYZ company or bank will open the account of a bank, XYZ bank, XYZ company. These are artificial personal account. Representative person like outstanding salary, prepaid insurance. These are called representative personal account. Apart from personal account, we have impersonal account that are not personal. Impersonal accounts are again divided into real account and nominal account. The real account are those accounts relating to assets and properties like machinery account, equipment account, furniture account. These accounts are called real account. Nominal accounts are the accounts relating to expenses, losses, incomes, gains, etc. Example are salary account, wages account, rent account, printing and stationery account, interest account, commission account, discount account. These are the examples of expenses, losses, incomes and gains. These are called nominal accounts. In this way, we have categorized into three accounts: personal account, real account, nominal account. Personal account relating to persons, real account relating to assets and properties, and nominal account relating to expenses, losses, incomes and gains. Now the rules, the golden rules regarding the accounts that you have to remember. These rules will be applied when we journalize the transactions. When we pass the journal entry, we follow the rules. What are the rules? Accounting rules. Personal account: debit the receiver, credit the giver. Whenever we have a transaction with a person, we have to see, suppose we are having a business and our customer is Mr. X. Now we have to see whether Mr. X is the receiver or giver. If Mr. X is the receiver, we debit the receiver. Suppose we sold goods to Mr. X. We sold goods to Mr. X. So Mr. X is the receiver. Debit the receiver. Suppose Mr. X has paid the amount. Mr. X has paid the amount to us. So Mr. X is the giver. His account is credited. The rule is debit the receiver, credit the giver in personal accounts. So whenever we have a transaction with a person, we have to see whether that person is a receiver or giver. If he is a receiver, debit him. If he is a giver, credit him. That's it. Secondly, real account. Real account are relating to assets and properties. The rule is debit what comes in, credit what goes out. Suppose the property is coming in, we debit. Suppose the asset is going out, we credit. Example, when we purchase the machinery, the machinery is coming in because we have purchased the machinery. The machinery comes in, machinery is debited. Machinery is debited. Similarly, if old furniture is there, we have sold off. We have sold off the old furniture. Furniture is going out. The furniture account is credited. That means in assets and properties, we see if it is coming in, debit. If it is going out, credit. That is the rule in real account. In nominal account, debit all expenses and losses, credit all incomes and gains. In nominal accounts are accounts relating to expenses, losses, incomes and gains. If you see that it is an expense or loss, it will be debited. If you see it is an income or gain, you should credit it. Example, the business has paid the salary. The business has paid the rent. So the salary and rent are expenses. It should be debited. Salary account should be debited. Rent account should be debited. Discount account should be debited. Similarly, if the business has received any income like interest received, commission received, discount received, it's an income. So interest received, commission received, discount received is an income. It should be credited. So these are the rules. These are called the accounting rules. While journalizing the transactions, we should follow these rules. Which account should be debited and which account should be credited. Now, alternative rules of debit and credit are formulated by American accountants. A new method have been started in America. That new method of debiting and crediting. This is the traditional method. Conventional method of recording the transaction is by following these rules. But the new method which is being formulated by American accountants is accounts are classified into 5 categories. So in America, the accounts have been classified into 5 categories. The categories are assets accounts, liabilities accounts, capital account, expenses and losses accounts, incomes and gains account. So all the accounts they have classified into 5 categories, right? In America. Now how the transaction will be recorded? Rules. What are the rules they will apply in American method? That method is called accounting equation method. This traditional method is different, and this is the new method which is followed by American accountants, that is called accounting equation method. And according to this, in case of assets, debit increase in assets, credit decrease in assets. If the assets are increasing, debit. If the assets are decreasing, credit. That is the rule. Secondly, in case of liabilities, debit in case of decrease in liability. It's opposite. In case of assets, increase in asset debited, decrease in asset credited. But in case of liability, debit, decrease in liability. If decrease in liability is the debit, if increase in liability is the credit. And in case of capital, debit, decrease in capital, credit, increase in capital. This is in case of capital. Then expenses and losses, debit, increase in expenses and losses, debit, decrease in expenses and losses, credit. Now in case of incomes and gains, debit, decrease in incomes and gains. If income and gain is decreasing, debit. If income and gain is increasing, credit. So these are the rules which are followed in accounting equation method by American accountants according to new method of recording the transaction. One thing you remember, whether we follow the traditional conventional method or new method by American method, accounting equation method, the ultimate result will be same. There is no change in the result. Only the method of recording has changed. But ultimate result of accounting will be same, whether we follow conventional method or whether we follow accounting equation method. That's it. Now, compound entry. Very frequently in examination, a theory question may be asked short. What do you mean by compound entry? So when 2 or more transactions of the same nature takes place on the same date. On the same date, 2 or more transactions of the same nature. Same nature transaction, 2 or more are conducted on the same date. So instead of passing 2 different entries, we can combine it and pass only 1 entry. So in nature take place on the same date, a composite or compound or combined entry will be passed. For example, a composite entry, it is called composite entry, it is called combined entry, right? So what do you mean by this composite entry or compound entry? For example I'll give you. On a particular day, rent is paid, salaries are paid, wages are paid. So all these are paid. Rent is paid, salary is paid, wages are paid. So instead of passing 3 different entries for payment of salary, for payment of rent, for payment of wages, instead of passing 3 separate entries, we can pass only 1 entry, combined entry. The combined entry is salary account data, wages account data, rent account data to cash. This is called a compound entry or composite entry. That's it. Now next thing is opening entry. every year, at the end of the year, all the accounts are closed. All the accounts are closed. So some accounts are closed by transferring it to revenue account. Example, profit and loss account. So in a business organization, all nominal accounts relating to expenses, losses, incomes and gains, these nominal accounts will be closed every year by transferring it to revenue account, profit and loss account. But what about real account and personal account? They may not be closed. It will not be transferred to revenue account. It will still be there. So 1 year closing will become next year opening. The current year closing balances will become next year's opening balances. So we have to pass an opening entry at the beginning of the next year. At the beginning of the next year, we have to pass an opening entry. So how to pass the opening entry? Debit all the assets, credit all the liabilities and credit the capital. So capital and liabilities are credited and all assets are debited at the beginning of the year. And these opening balances are coming from the last year's closing. So last year's closing will become current year's opening. So how to pass the opening entry? Debit all assets, credit all liabilities and credit the capital. The total of assets, debit and credit will be equal. So this is the explanation about opening entry.